Anyway, so we are going to talk about this world of investing in consumer and retail M&A from the point of view of the investment bankers. So our last panel was on really, they are the buyers. These guys are the sellers. So we're going to try not to cover, we very specifically did not want to cover what they would cover. Previously, the private equity panel, so they did all the easy questions. We're going to do all the hard questions. And why don't we, let me just have everybody go down the line and just who you are, what your firm is, and a fact about you that nobody here would know.
Nobody would know. Thank you, Billy. Marianne Domuracki. I'm with MMG Advisors. We're a boutique investment bank located here in New York and have a particular focus on supply chain and consumer retail-based businesses. It's a 30-year-old firm. Fact that nobody would know. I have a wonderful puppy named Holly.
I'm Billy Susman. I run Threadstone Advisors, similarly doing across all consumer retail. I guess my fun fact, as I pass it to my Busko, I have one tuition left in my life.
That's good.
Hello everyone, my name is Billy Busko. I'm with Consensus Advisors. And I guess my fun fact is that I have a 6-month-old baby girl.
Oh my God. Better you
Yeah, and you need to start really opening up that 529. Because by the time she goes, it's going to be $1 million. Richard?
I'm Richard Kestenbaum from Triangle Capital. We do M&A and capital raising in consumer and retail. I am also a regular contributor to Forbes.com. I have no fun facts. The only thing you wouldn't know about me is I have a 4.8 rating at Uber.
Terrific. That's great. Good stuff. So we're going to cover 4 or 5 areas, kind of do it in depth. They're fairly broad questions, and we will leave time for Q&A because I know what this audience is like. So first question, let me start with Billy Busko. But everybody's going to be able to chime in on this. So talk about what's happening in the market right now for deals in the retail and consumer space. A number of different areas, purchase, what are the purchase prices like? Who are the buyers and sellers? What are some of the hot and cold sectors, et cetera?
Okay, very good, Richard, thank you. Well, there's that saying that tall trees don't grow to the sky. It does seem for the past 10 years or so that the good times continue to generally roll. In my opinion, I think it's a function of a few factors. One, available capital, and also strategic objectives. So the amount of capital in private equity hands today is at an all-time high. It's $2.5 trillion. The cost of debt is very low, as we know. And when you look at strategics, they are finding, I think, it difficult to find organic growth. So they're looking for ways to grow, and obviously acquisitions are one of their priorities, particularly if there can be high synergies. The stock market is high, the economy has been strong, so I think people feel emboldened. So what does this mean? Last year, the median EBITDA multiple for an M&A transaction was 12.4 times EBITDA. Wow. On the consumer product side, total activity was $40 billion, up 25% from the previous year. I'm not yet seeing those stats for the retail sector, though. But I do think that continues to be a barbell environment. So if you look at Tiffany's being bought by LVMH at 4 times revenues, 16 times EBITDA, that is obviously a premium company selling for a premium multiple. Then you have the other end, the underperforming company Barney's. Deal still got done, but at $250 million. I think that where deals are getting stuck are those in the middle, where those companies, those owners think that they're worth that 12, 14 times EBITDA, but they're not. And they're having a tough time trying to reconcile what their worth is relative to where the market thinks that they are. Regarding sector performance, generally speaking, I think retail, brick and mortar remains obviously very challenged. We used to ask our clients, what is your e-commerce strategy? That may be the first question we ask. The second question is, what is your Amazon strategy in particular? So mall traffic was down this past year for the 8th year in a row. Store closings last year totaled about 8,000, led by Payless, Gymboree, Dress Barn. But at the same time, there are a lot of stores that are being opened. So a lot of the digitally native companies are saying, gosh, it's difficult to acquire more and more customers online. They're now opening a lot of stores such as Untitled and Warby Parker and Away and Adore Me. So that is offsetting some of the store closures, but not to the same degree. Looking at some particular subsectors, I think that you have really winners and losers. So I'll hone in on a few sectors. One is beauty. So on the very positive side, beauty's been hot for a very long time. And I think every December, every January, you have people saying it's got to cool off at some point, but it really has not cooled off. So some of the high-profile transactions last year included Drunken Monkey being bought by Shiseido at a very big multiple, Harry's being bought by Edgewell, which is Schick for a very big multiple. But then you have Avon's been on the market for a long, long time. It was finally acquired by a Brazilian company for a rather mediocre valuation. Revlon's been on the market for a very, very long time. So you have the winners and the losers in that sector. Same thing, I think, in home. I think tabletop is particularly challenged right now. People are getting married later. People are going to their parents' home after graduation. People are eating out more. There's a more casual lifestyle, so tabletop, I think, has sufferred. Even those companies that you think that might be more tech-oriented, home infrastructure, I think of Bose. Bose just announced a few days ago they're closing 150 stores in the U.S. But then you have Home Depot trading at an all-time high. And lastly, I'll talk to sporting goods, because this also is a function of the has and the has not. So Models continues to struggle, but if you're Peloton, now trading an $8 billion valuation, or SoulCycle, or Mirror, they've raised a lot of money. But I think it again comes down to the particulars around the companies, because SoulCycle has done very well, yet Flywheel went bankrupt. And if you consider those 2-3 years ago, you'd say, well, they're probably interchangeable. Well, the reality is they're not interchangeable.
Anyone else? Richard?
Hot sectors. Capital keeps flowing to pet, beauty, subscription, and retail technology. Capital is not flowing to fashion. But, as Billy said, it's not a flat field. It's very uneven. And likewise with valuation, it's true that you can use numbers to average out what valuations have been. But it's not real to say, well, valuations are 12 or whatever the number is, and then apply that to every company. One of the reasons the four of us have jobs at all is because there is no formula. So you can't say that the multiples are not the input into a transaction, they're the output. After you assess the team and the opportunity, the history, the margins, the capability, the opportunity in the sector, and all those things, you come out with a multiple. You don't go in with a multiple and say, well, therefore the value is this. So every transaction is really bespoke, and it's like any human relationship. You put two people in a room, you can't predict what the outcome is. Sometimes there's a connection and sometimes there isn't. And transactions work that way as well. So I think my whatever we are here, panelists would agree that it's every transaction is different, and you spend half your time being a banker and half your time being a therapist. And you have to understand what people's motivations are, and that's the charm and beauty of doing a transaction. So it's an uneven world.
In terms of categories and space that is either hot or cold, and where we see some changes, for a long time, I'd say the past 3 to 5 years, we would say it's not an apparel market, with apparel being particularly soft at retail. And retailers, even today, you'll find most of the closures are certainly in the apparel sector. We've seen a real change in that in the last year, and just recently closed 2 different transactions in the apparel space. I'll talk a bit more about that when we get to supply chain. And I think you'll continue to see that going forward. Also see footwear was hotter than anything you could imagine in the past few years. It's still strong. I don't know that I would say it's as hot as it was before. What is resonating, and we'll get to this a little bit later from my remarks, is the relevance of supply chain. and how important it is to both buyers and sellers and what they can bring to the end consumer.
I think I tweak a couple of comments. I agree with Richard and Marianne on fashion. I do think, and Marianne suggested this, accessories are different. Handbags and footwear still seem to command much higher premiums than a traditional apparel company, but I think it's all, kind of in context. Is it millennial? Is it digitally distributed? Is it more luxury versus is it more private label, more department stores? So I think distribution always matters, price point matters. I think to one of Richard's comments, I think pet products remain very hot. I think pet retail gets trapped a little bit in Billy's comment about what's happening in mall traffic and in store, particularly when you can get dog food delivered pretty much cheaper than going out and having to buy it. The two other comments I'd make on this, to Billy's comment about the high multiples, I think two things. You can have a high multiple for two ways. One is you don't have any EBITDA. So I also think you have to always peel through it. We think today valuation is kind of triangulating. You have to have an EBITDA multiple that makes sense in the context of a revenue multiple that makes sense. And in the earlier panel, the repeated comment was path to profitability, ultimately to have a cash flow model that works. We find that the deals are getting done if all three of those kind of come together. And I think the last comment, I think part of why we think beauty is remaining so hot, so transactional, is because they continue to invent newness. Clearly, clean beauty is going to be a topic in 2020 that really wasn't talked as much about a year ago. So I think you're seeing new opportunities. Beauty is a category where their distribution, what happens at Sephora, what happens at Ulta, so matters for brands that's driving a lot of the outcome of these transactions.
Perfect. So we're probably I want to come back to some of these themes, but I want to go ahead and move to the next topics, and then we're able to cover all the things that we discussed in our prep call. Next question for Richard is, talk to us about the elements that strategic and financial buyers are really prioritizing today. Is it growth? Is it profitability? Is it team? Is it something else? It's probably a combination of those. But if you could talk about some of the differences in terms of buyers who are looking for one versus the other.
Well, we're in a transitionary period. 2 years ago, you would have seen a lot of bidding, and I have to say, we sold companies for some crazy values that was based on growth, and growth alone, and growth in top line. And there was an assumption that if there's growth in top line, there's got to be profit in there somewhere, and it'll eventually come, and if we can get that growth, this is what we want. Well, we've all seen that as different forms of businesses are created, financial markets often overreact, and they overvalue those things, and there's numerous examples of that. And therefore, as new forms of business came on, growth was the thing. Now we're seeing the shakeout in those markets, and so profitability has come back into fashion. And so we are seeing that companies that can demonstrate clear paths to profitability growth are driving higher values, and there's less capital available now for companies that can't do that or can't demonstrate profitability in the long run or in a very short, clear period of time. My colleagues and I at Triangle Capital kind of worship at the altar of gross margin, because if you think about a business the way we do, we're financial people, I think about it in terms of financial statements. So if you think about the income statement, there's net revenue, cost of goods sold, and gross profit. And getting that gross profit and the gross margin to be a super positive number is the hardest thing in the can create gross margin that's attractive and sustainable, you can have a valuable business. If you can't do that, nothing else will really help you. So We, of course, as we primarily represent sellers of businesses, we want to put them in the best light. The best thing for us is to have a company with great gross margin and great growth. That's what investors are looking for, and we can position a business with those characteristics in the best possible light. Of course, investors want growth. Of course, they want bottom line, but there are ways to position it in the stream of what consumers want if you have positive gross margin. That says consumers will pay. They understand they're not buying something at commodity value, and that is how you generate a great value for a business, and everything else can come after that.
I think for a financial buyer, I think a couple of thoughts. One, I think they care about how they ultimately get out of it. Are they going to get out of it through a recap? Are they going to get out of it through an IPO? Are they going to get out of it through another buyer? How does a financial buyer create value? Three ways. Grow EBITDA, or gross margin in the business, get out for a higher multiple, or delever. I think the financial investment world today is a little bit bifurcated. The growth investments are much more not debt-driven, much more equity-driven, versus larger cash flow type opportunities where you can put 4 or 5, 6 times leverage and get some of your return that way. So I think that's partially how the financial community. To your question on the strategic, my observation, I'm curious about others, I think it's one of two things, two basic emotions, greed and fear. And what I mean by that is I think a lot of strategic transactions today are being done opportunistic, particularly on the fashion side. I have a $500 million company, adding another $50 million brand. I can buy just gross margin. I don't need any overhead. Pretty opportunistic, pretty greedy. I think there are people doing transactions, and I'm going to forget the name of the app that Nike and Under Armour all bid on and bought. You'll remember the name of it probably. But why do they overpay? Because they're afraid they're not acquiring customers in that format, and they're afraid that they're going to miss something. So I think strategics are always doing transactions second on getting a model to work, and first answering the question of why are they buying?
I think another important aspect for strategics is looking to acquire capabilities that they currently lack. And particularly with one of the traditional companies that may lack the e-commerce capability or the social media capability. And we are working with a couple of clients based here in the U.S. today that have been approached by international parties. So not just looking for just the footprint in the U.S., but the ability to drive e-commerce growth, to have social media success here in this market.
I agree with that. We see a lot of companies, strategics in particular, looking for e-commerce growth or diversifying their customer base. It's a driver of growth. Old line, middle market, large companies, small companies. We represented a global business in intimate apparel, Walcol, who really wanted to find a young intimate apparel e-commerce brand, and they valued the operator and that business dearly. And so, to your point of a little bit of fear, maybe a little bit of growth along the way, what are they missing was a lot of that conversation.
Terrific. So let's move to the next question for Mary Ann. Hope you don't mind speaking twice in a row here. And we have seen a lot of retail consolidation taking place in the last few years. It seems to be accelerating by a number of companies simply disappearing. And how has that affected the ability of vendors and brands to get deals done?
So it certainly has affected it, and there are fewer retailers today. There are fewer suppliers today. There are fewer doors out there for people to sell to. What does that really mean for deals getting done with the supply chain? Is they're very focused on how do we improve our bottom line? What do we have to do to get that margin that Richard talked about? How can we diversify our brands? How can we really capture more volume? So a few examples. Selling Vince Camuto within the last 2 years, good middle market brand, unknown little secret to maybe the common individual or consumer is that they were incredible at sourcing. They were a supply chain genius. DSW steps up and says, I value that supply chain probably more than I even value the brand. And so that transaction got done fairly quickly, and they were very aggressive about it. Also, similarly, this past 30 days, we've closed 3 transactions, 2 of them in apparel, 1 of them in footwear. All of them had some element of needing supply chain improvements. One company, a smaller business that was acquired by a large privately owned company, the smaller business turned their inventory 10 times a year. The larger one, 1.25, if they were lucky. So yes, gross margin was much better, and they clearly value that very dearly. It could have been an opportunistic buy, but in order to treat everybody fairly, there's a lot of structure that's happening in private deals. Some private equity funds can work with that, the majority of them cannot. But structure does help solve the gap on value quite a bit from what we've seen. And so I think we're going to continue to see supply chain, and that takes a lot of different meanings. It's, can I source out of China to avoid tariffs? We had 4 deals go on hold last year because of tariffs. It's real. Companies that had the impact of tariffs, and I think it's one of your later questions actually, but the impact of tariffs cost a lot of money to companies that were profitable. And so some of those businesses need solutions now. That's a driver going forward in a lot of businesses. And so, we're big believers in solution-oriented M&A, and we see supply chain as a big driver of that.
The only thing I'd say, Marianne talked about the pressure on store closings. If you listen to NRF, if you listen to MasterCard, retail this holiday season was up 4%, ex-auto, ex-gas. And I think that is what we don't talk as much about supply chain, we talk much more about changing distribution lanes. And I don't think the customer is buying less, I think they're buying differently. I also think the type of product they're buying is very different. It got to the earlier panel conversation about Baum, how they source cashmere, to Marianne's supply chain. But I think distribution, changing distribution. Probably a year ago, to something Billy suggested, we used to ask every company the first question, how are you going to survive in an Amazon world? We actually ask that less because more brands have figured out whether they can or can't survive. The bigger question is, how are they surviving in general?
Supply chain is more important now for a lot of reasons. And the biggest reason is what's happening online. And I don't mean that you have to ship onesies, twosies direct to consumer, but rather because the way in which stores and direct to consumer interact. Because there's buy online, pick up in store, and buy online, return in store, and both those things cause products to be in the wrong place. And it's very hard for big companies, legacy companies, to get those legacy systems to work in this new reality. So if you were at NRF, an enormous amount is focused on what the guy at Zebra Technology said to me. He said, we answered 4 questions, and notwithstanding its relation to a particular holiday, it makes me think what his questions are, what is it, where is it, how is it, and what am I going to do about it? And everyone is struggling with that question because particularly when a return comes to a store, it's in the wrong place and it costs money to move it. So thinking about your clients who had terms of 1.5 and 10, the 10 sounds great. The 10 is really a huge problem. It means that they're ticking off their customers because they're stocking out all the time, and they have enormous problems with their supply chain. And you don't want to be the company with a 10 times turn, because if you can't fix your problems, next year, a lot's going to change and it's not going to be good. So supply chain is really important to developing long-term strength, long-term profitability, and being able to present yourself as a company that has long-term viability and true enduring value.
I also think that as evidence of the importance of supply chain, I think that a number of years ago, acquirers would not diligence the supply chain, and now they do. They go overseas and they spend days at these factories. I also think it's in part because I think there's a greater reliance on innovation from those overseas partners today than there was maybe 10, 12 years ago. So another reason why I think the strategics are going overseas and really understanding what those partnerships look like and the sustainability of those partnerships.
Really, to your point about diligence, thank you for making that, because that is a very important change, and I think how diligence impacts deals now. Buyers want to speak to factories before they close, in addition to speaking to customers. So there's definitely a huge difference in how people diligence deals now. And deals take longer. That's really the impact of all of that. And the good news is, for our clients anyway, we bought the client who was turning 9 times. It wasn't on stocks. So we were happy to find that one out. So just efficient.
So our last formal question, which is for Billy, Billy S., not Billy B. So can you talk about the impact? There were several high-profile, disappointing holiday and Q4 results that were reported by a number of companies, both big, medium, and small, including folks like Target, good number, but below expectations. Kohl's, the same. And, big disaster at Five Below, which had like 10 years of straight comps. How has that impacted the deal market as we move into 2020?
So I think that I suspect none of the four of us are on a daily basis tracking stock prices and where things are trading on a daily basis. I think all four of us are probably cognizant of public valuations. The answer for me is it's really confusing. I kind of go back to things people like Mickey Drexel used to say, product actually matters. A good store experience matters. But I don't know if anyone in the room has actually been into a renovated Target in the last couple of months. They're kind of amazing. The beauty department in Target, the offering is incredible. And why they missed their numbers. Now, I think there's a little bit of a sense, maybe they didn't chase revenue in exchange for profit, and time will tell on that. But again, they come out with a comp below expectation, stocks off 7, 8, 9 points. You look at what the new CEO, Michelle Gass at Kohl's is doing, and it's terrific. Joint ventures, I like the word collaboration, with Amazon, with Weight Watchers. This is what the customer wants and needs. She's making a better store experience. Now, it'll take some time, but the answer is it's very, very confusing. I also think that sometimes it's very hard to be public, and I refer to someone like Ulta. Ulta for years could do no wrong. Every store opening, the number of store openings, the pace of growth, the execution was flawless. And then what? And then you get to a certain scale where you just can't keep doing it the same way, and the market has no patience or tolerance. So, you look at Target and Kohl's and Five Below in these situations, and I think the answer is to revert back to, in a retail environment, who's offering a good experience on the product side, who's got a good product. And to me, that's, I think, what's the underlying answer to a confusing public market. All yours.
Those stores not doing well, no, it's not good. But as Billy said, it's not a minute-by-minute thing. There's an environment for M&A, and it's the general economic environment. And it means how people feel. Are they exuberant? When I think most of the people here traffic in M&A in one form or another in their careers. It's a normal thing for you. It's kind of an outlandish thing to do, to buy another company. It takes a lot of confidence to do that. When the environment is not supporting of that confidence, it's a hard thing to get done. Our businesses suffer when general confidence is low. Things like poor earnings at Target and Kohl's, sure, those are data points, and those affect confidence. Not immediately, but if it keeps on happening, if 4 out of 5 retailers announce numbers like that, it's going to be bad for us. And conversely, when there's a lot of earnings, when equity values are increasing, that's great for us because people come in confident that they can buy something and the rising tide will lift their boat no matter what happens. So we can do well in a confident environment. In a non-confident environment, it's tough, and it's very hard to get buyers or sellers to move forward, because you have to have a certain level of belief in the future, because a buyer is buying the future and we're selling the future when we sell a company, and they need to feel comfortable about the present.
I think beyond just quarterly results, I think that what can be more troublesome to investors is how retailers are shifting their business, and what that means then to the suppliers. So, for instance, if you look at Target just announcing to stop carrying C9 by Champion, they're replacing it with their own brand. You have Bed Bath & Beyond saying we're going to carry fewer and fewer third-party brands, we're going to focus on our own brands. So if you have a brand at Bed Bath & Beyond, or Target is doing very well, odds are it will continue to do well because they're going to focus on certain brands. But if you're a moderate performer at a retailer that's shifting toward internal brands, then you're going to be in trouble. And that's clearly going to be affected, or going to be reflected in how a party thinks about your value and your sustainability.
On one of the earlier panels, someone raised the topic of concentration risk for businesses. And so in the environment where there are fewer and fewer retailers, concentration risk is very real, whether it's Amazon, whether it's Macy's, whether it's JCPenney or Target in those examples. And so certainly I think the disappointing results lead one to ask a lot of questions around, since most companies have some concentration, what are the risks around combining two businesses that have similar concentrations? Can you withstand the potential shift at JCPenney or Target from a C9 to a private label brand? How long have you been a vendor there? Will you accommodate and be protected somewhat? Maybe they come to you for the next version. So diligence changes. It takes more time. People want to see how holiday season's results come out before they actually close on deals. And those are raise the level of risk in a lot of deals that are happening. But it also can drive them, can make the need to get something done even greater.
I want to pick up on something Billy was talking about, brands in stores. You may have brands in your life that you enjoy having, that you identify with, that you associate with, that you'll pay up for. And lots of people have that. But in general, brands are less important now. And we are seeing the commoditization of brands, slowly but surely. It's not happening to Chanel or Gucci. They're moving in another direction, and there are exceptions to every rule. But as a general rule, brands are becoming commoditized, and it's one of the reasons why direct-to-consumer is so important. It's one of the reasons why having a relationship with your consumer that goes in two directions, where they respond to you and you react to them, is so important. That's how brands are creating, and retailers are creating, relationships with their consumers, identity and association that allow them to sell products at full price and get that gross margin.
I was just going to, I think Richard kind of made the point. I think that logos matter less. I think brands still matter, because I think particularly millennials identify with brands, whether it's through the direct to consumer channel. There was somewhere recently where somebody said, you have to stop referring to it as social media. It's just media now. But I was speaking earlier today, there's a brand I'm aware of that, I don't even know what TikTok is, but did TikTok.
Look behind you. Look behind you.
I saw the ad, and got 2 million views or whatever you get on TikTok, and that can move the needle. So I think that millennials want to associate with brands. One of the challenges is, are they associating with it because it's their little secret, and when all their friends know about it, they don't want it anymore?
Yeah.
When do consumers turn on a brand? So I think there's that relationship.
I get why you say that. I'm observing it in a different way. What I see is they're associating not so much with brands, but with values that they share and people who share those values. And when they express those values, they want the products that allow them to identify with the values that are espoused by the people who are running the brand. Why is that happening? First of all, I have no facts or data for what I'm about to say. But if you think about the period following the period of Reconstruction in the United States from 1865 to 1900, the presidents of the United States in that period had less influence than their predecessors or the presidents that came after them. And the names you remember from that period were leaders in business. That's who people looked to. They were Rockefeller and Mellon and Carnegie and many other people. It may be that we are entering a period like that now. We may be deep in it. And if we are, it means that people look for values to business. And that's an enormous opportunity for people to express values in their brand. It's what we are seeing. It's not different than what you're saying. It's another interpretation of what does a brand mean? Why does it exist? And if that's right, then associating values with your brand is a fantastic way to create leadership that creates a following that is impacted on media, and that creates sales. And that can endure, and it creates a crazy ton of value.
This topic of do brands matter is actually a topic we hear a great deal about, and have a pretty feisty debate like we could potentially have here. I think there's a fair number of us that believe brands really do matter. We've met with data analytics companies who will argue with us up high sky ceilings to say that they really don't matter. If you think about it, Target took a little bit of the view that brands don't matter. They threw out...
Or that they're the brand.
Or they're the brand, correct. They threw out Cherokee a couple years ago, and now C9 this recent time. They believe they can easily build their own and the consumer will come. So this is a debate that is pretty high front level amongst a lot of companies. Companies are actually building their business model around the belief that brands don't matter. And then there are businesses who are building their belief that brands really, really do matter, and they're on TikTok.
Whatever it is.
I'll add that I think a lot of the new brands, although they lack the heritage, they are good at storytelling. And I think storytelling is very important. So think about Untuckit. I first saw the first Untuckit show probably 5 years ago. I thought it was the dumbest thing in the world. They told a great story around that. And now I think it's doing very, very well. And they're one of the up-and-coming companies that is adding a lot of retail footprint. Baum, the sock company, has done a great job of storytelling. We give a pair of socks away for every pair that you buy to the homeless. And they're very smart about it. Like, we've actually done our diligence. We know that the homeless want to have a pair of black socks because their feet are going to get dirtier than our feet will be. So they tell the story very well. So although they lack the brand heritage, they replace that with a great story.
So how do you explain something like, talking about the bottom part of one's body? Tom's, for example, which gives away a pair of shoes for every pair that they sell. I think these follow Chapter 11?
It's got a new owner. The debt now owns the equity. But finish the question.
So the question was, how do you, there's a great mission there, and we hear a lot about mission-based businesses and things that people can relate to, and sometimes people will pay for that because they relate to it, and sometimes they won't.
So you got to always separate a bad company from a bad balance sheet. And I think that it was private equity owned, it was extremely highly levered, it needed to grow meaningfully to maintain and sustain that leverage, and that caught up to it. So the private equity firm, at a certain point, hands the keys to the banks. Whoever bought the debt pretty cheap came in and now runs and owns the company. I think that that's not your question. I think your question kind of is that Tom's is a consumer offering as a brand, as a product. I think that, like Crocs, per se, it has a niche in the market. Not everybody wears Tom's, but clearly some people do. To Richard's point earlier, if you're going to give away, I think the number is like 100 million pairs of shoes since they started, you have to have enough margin to be able to afford that and still have a viable business. particularly if you're going to put debt on your balance sheet, or particularly if you're going to go to a private equity firm. The question that I think is where Mary Ann was kind of going, in 20 years, in 40 years, will people know Tom's as a brand? And this is a challenge. I mean, I believe Tory Burch is a brand. I don't think it's going away, no matter what happens to her. I'm not sure Away is going to become the luggage requirement for the next 100 years. I don't
It's like
know.
away may go away.
Exactly. But so I think the verdict is still out a little bit, and where I think on Tom specifically, like a Crocs, I think it'll have a lane. The question is how big can that lane be?
Right. Richard, you want to counterpoint here?
I want to answer your question with what Billy Susman said a moment ago. You can't forget about product. You can have all the great values you want, but if you don't adapt your product, if you only have one note to play, it gets boring. So that's one of the ways in which retail and consumer is so much harder than it ever was, because yes, you have to have all these values in communication and media and present yourself in new and interesting ways. But that doesn't mean that you can slack off on all the things you needed before, particularly a product. If your product's not great, if your product's not evolving with your consumer, none of that, nothing else is going to matter. So great product is table stakes where it used to be the only thing. It still counts. There's just a number of other things that are also just as important now.
And it's pretty cool.
Yeah, I agree with that very much, Richard. In fact, I think two good analogies of that are Carmex and Burt's Bees. They start off with the same thing. Who'd rather be Burt's Bees or Carmex today? And to Billy's point, Crocs or UGG. Because UGG was also known for one thing, but UGG was able to diversify away and really create a brand. So it does come back to the product and then be able to diversify beyond that.
So we've got about 10 minutes left. I'd love to open the floor to questions. There's been a lot of pretty interesting things said today. Fair amount of controversy even amongst these panelists who generally always agree with each other. Any questions? Joel.
All right, so first of all, I think you guys are terrific. I mean, you really covered a lot of stuff, and I happen to agree with all of it.
Thank you.
And maybe it's the financial heritage.
I'm sure it's a financial heritage. By the way, that's Joel who worked at Financo.
All right, so the thing that I was interested in listening and hearing, the talking points around the value of a brand and the growth opportunities that people pay for, right? And indeed, there have been many brands that have traded at levels that people go, oh, that's a crazy number. And then they take it and they grow it beyond anybody else's expectations. And all of a sudden, that multiple that was so big is a year later is it's like a bargain. How do you, as a banker, how do you assess and how do you help the buyer assess what the upside is on a brand? You know, remembering the days we looked at Canada Goose. Is that right? Canada, the winter.
Yeah, Canada Goose.
And they were doing pretty well, good business. Traded at a multiple that we thought that was pretty expensive. And was it Baum that bought it?
Yeah.
And took it to the
Yes.
stratosphere.
Yeah.
And then companies like Lululemon, or was mentioned Peloton. I mean, these are brands that somehow they continue to really. So how do you get to the bottom of that when you're trying to present a business?
I guess my first thought is, I always go back to Altro. Would you rather buy or sell 10 times 50 million of EBITDA or 8 times 500 million of EBITDA? So point of investment, timing, I think always matters. I think to the second part of kind of what you were asking and alluding to is, what is a brand's ultimate potential and runway? I think when Canada Goose was at that inflection point, at a $100 million kind of company, people could see there was a $1 billion opportunity. I think at a certain point, you know, and Lululemon may be a good example, does a brand ever hit a wall and then need to reinvent? So I think ultimately what is the definable market kind of always matters. And you know, brands go up and down and reinvent. I can think of a couple, but I won't name it.
Go ahead.
Just partly on that, Lululemon, I think, helped to create a category. So there was an opportunity for exponential growth for a long, long time. Just like Under Armour did the same thing, I think. I think Canada Goose had a great heritage and a great story, but had not really been told very well. So I think someone said, you know what, we can back Canada Goose. There's a great story here, and we can leverage that story. Because they didn't create a category. There's been outerwear for a long, long time. They've helped to, I think, distinguish a brand within a very large addressable market.
And then, not to be too boring on the topic of supply chain, but I'll go right there. So in the world of when people looked at the Vince Camuto transaction and said, "Wow, what a multiple that was," and the interesting thing was, at the end of the day, within 12 months, they realized their value was probably they paid too little, all from supply chain. The brand was icing. So interesting observations from a different angle.
So I'd like to weigh in on this if I could, Richard. And that is the importance of the management team that you're backing. I think this is where it really becomes critical. And so, there are management teams that really, they have great operators and they have great vision and they have a great story to tell. And I think oftentimes that is worth several multiple points. That's not often appreciated. And we, for example, hi Carolyn, was that?
5 minutes.
Oh, I thought you were awake. So, for example, we tend to be, at Consumer Growth Partners, we're more value investors. And we say the deals that we don't even go near are where there's a great concept, it's growing like a weed, and they've got the all-star management team. What do they need? All they need is money. They don't need any help, they just need money. And if you go back and look at some of these great companies that, were brands that were garbage to begin with, I know as a public equity research analyst, Abercrombie & Fitch. Abercrombie & Fitch was a bankrupt company. Michael Jeffries comes along and he literally invents the story behind Abercrombie & Fitch, and it becomes a moonshot. Same thing with Chip Wilson at Lululemon, and I'm sure that there's many, many other examples of this.
But you got to finish the Abercrombie story, because then it hits a moment where it's kind of back in the trough and it's kind of teetering on maybe bankruptcy.
Yep.
Arthur Martinez brings in Fran
Horowitz.
Thank you.
Yeah.
And I haven't checked, but I think it's pretty big and stable and attractive.
It's a
So
little.
brands don't go through lives.
But but the run was from 1998 to 2010 or more. So it's a pretty good 12-year run. And they do hit the wall, and part of it is, to Richard's point, you stop reinventing. If you look, those Abercrombie stores got to be old and stale and the same story, and that is really important as continuing to evolve. Who would have thought that I spent some years in the outerwear business. I would have said, Canada, are you kidding me? It's like a friggin' down outerwear company, and there is nothing special about that product.
At a premium price.
At a premium, yeah, that's the only thing that's special, is that, you have to pay
They're
twice
ugly
to
clothes.
I still don't get it, but
Ugly clothes.
that's why I'm still working.
But ugly are ugly too.
Marie?
Ugly are ugly too. So ugly isn't the arbiter.
She's an
One comment I actually want to just follow up on your topic is management. We actually didn't focus enough on management and how much it really matters at the end of the day. And people do invest in management. Private companies, we talk a lot about cultural fit between the two companies, and can an owner who's actually founded and run their business for maybe 30 years ever work for somebody else? It's a big deal, because if they can't, they're gone in a year and they basically bought nothing. In the case of Wacol buying Lively, at the end of the day, it really was the CEO and the founder who sold that deal. She was experienced, savvy, smart, creative, created stories, and they invested, all around that. But we didn't talk enough about management. It matters a lot. It's a multiple or two.
Joel, I think your question is, how do you get to the true value? Our business, I suspect their business too, is primarily representing sellers on an exclusive basis. And what we're trying to do there, conceptually, is say, what is happening in the stream of what consumers want now, and how does what we're selling fit into that? We, conceptually speaking, we run a funnel process. We put people in at the top, and what we're trying to get to come out at the bottom is identify the people to whom it has the greatest value. The value to them is what we are looking for, because that's how we maximize the interest of the client who we serve, and we need to maximize their interest. So, you know, the overlap between what the buyer says and what those people at the bottom of that funnel are saying is perhaps where true value is, but the people at the bottom of that funnel, they're the ones that have a reason to be the best buyers of whatever we are selling. And sometimes you can see that reason apparently, sometimes you can't. But when you fit it into the stream of what consumers want now, and you identify it, and you tell that story, and then you run the funnel, that's how you get the highest value, which is what we're after.